People often believe that sitting on a large pile of cash is a sign of indecision, fear, or lost opportunity. But when you look closer at the minds behind some of the world's most successful financial decisions, you'll find something very different. Patience, preparation, and precision. These are not the qualities of gamblers. They're the marks of disciplined architects building for decades, not quarters. Right now, the United States is operating with a fiscal deficit that, if left unchecked, cannot continue indefinitely. It's not a matter of opinion. It's simple mathematics. We don't know whether this trajectory has 2 years left or 20, but the principle remains the same. Anything that is unsustainable will eventually stop. Herbert Stein, a former chairman of the Council of Economic Advisors, said it best. If something cannot go on forever, it will stop. So, what does this mean for investors? It means you have to build your philosophy around the unpredictable nature of financial systems. If it makes you uncomfortable when your portfolio drops 15%, it's time to reconsider how you invest. It's not just about riding the highs. True wealth builders know how to sit through the lows. Not because they enjoy it, but because they understand what lies on the other side. One of the most insightful shareholder questions recently came from Advait Prasad in New York. He pointed out that Berkshire Hathaway currently holds over $300 billion in cash and short-term investments. That's nearly 27% of its total assets, double its 25-year average. Why hold so much cash? Is it just a safety net? Or is there a bigger game at play? The answer might surprise you. It's not about hoarding cash out of fear. It's about waiting for the right moment. The kind of moment when you're not reacting emotionally to the markets, but striking with clarity. When a company's leadership deliberately chooses liquidity, they're not retreating from opportunity. They're positioning themselves to leap when the opportunity is real. In the investment world, nothing comes in a neat schedule. There are no 4 perfect deals handed to you every day. Sometimes you wait through silence. You flip through hundreds of financial reports, often in languages you don't read fluently, chasing one opportunity that feels just right. And when it comes, you want to be ready. Because great opportunities don't knock politely. They come crashing in when most people are distracted. This is what distinguishes true investors from speculators. Charlie Munger once believed that if you made just 5 solid decisions in your lifetime, just 5, you'd likely outperform those making 50 average ones. This wasn't an exaggeration. It's a mindset. It's why Buffett and Munger never had a problem holding massive cash reserves, even when everyone else was rushing into the next big thing. And here's the most misunderstood truth of all. Cash in the right hands isn't idle. It's power, stored energy. It's a loaded spring waiting to be released when the moment is right. It's not timing the market in the conventional sense. It's about being strategically untethered, so you can act without hesitation when the rare, fat pitch appears. Imagine this. Berkshire could spend $100 billion tomorrow if the right deal surfaced. But here's what most people overlook. Those deals rarely surface when you're desperate to find them. They arrive when you're ready, when you're liquid, and when you're not afraid to wait. That's the real secret. The problem is, most investors think they need to be fully invested at all times to make money. But history shows that having the courage to sit still, to not chase every wave, is often what separates those who thrive from those who simply survive. Long-term investing success is not just about what you buy. It's about what you're willing not to buy. Think about the long view. In any 20-year period, there will almost certainly be a handful of moments that redefine everything. Major corrections, bubbles bursting, government interventions, unexpected global shifts. Those are the windows where fortunes are made or lost. And those who are unprepared will always look back with regret. The future will not come with a warning label. It won't wait for your portfolio to be perfectly balanced or for your emotions to feel safe. If you're going to succeed in this game, you'll need a strategy that honors uncertainty. That means building reserves. That means saying no, often. And that means keeping your attention sharp, while everyone else grows complacent. Warren Buffett doesn't build his investment thesis on tomorrow's market movements. In fact, he openly says that he has never met anyone whose market predictions were useful to him. What he does do is keep flipping the pages, digging, waiting, watching, and then he moves. Not in panic, not in hope, but in conviction. You won't get that kind of precision by watching the news. You won't find it by listening to analysts guess next quarter's earnings. You get it by building your tolerance for boredom, your respect for dry spells, and your discipline to act only when value stares you in the face. That's the game. Most never master it. You might want to ask yourself, if the market dropped 30% tomorrow, would you see fear or opportunity? If the answer is fear, maybe it's time to reassess not just your portfolio, but your philosophy. It's not about knowing what will happen. It's about knowing how you'll respond when it does. And now I'm curious to hear from you. What kind of investor do you see yourself becoming after this reflection? Share your thoughts below. And if this message made you rethink how you approach money, don't keep it to yourself. Pass it along. Someone else may need this today. There's an illusion that tends to fool even experienced investors. The illusion of stability. When a currency feels strong, when markets feel rational, when institutions look permanent, we assume the system will hold. But history has another story. Currencies rise and fall. Governments print too much. And even the mightiest economies flirt with the edge. This is why it matters who controls the money. Because no matter how advanced a society becomes, the temptation to debase a currency always lurks in the background. Politicians promise. Central banks respond. Voters want relief, not restraint. And just like that, we drift from responsibility into recklessness. Berkshire Hathaway, despite its size and power, does not try to predict the future of every currency. In fact, Warren Buffett has made it clear that they've never made investment decisions based on quarterly earnings or short-term forecasts. Their focus is long-term, not what the yen or dollar might do next month, but what they believe is inevitable over decades. Take their investments in Japanese companies, for instance. They weren't made because of a sudden bet on currency shifts. They were built on conviction in the companies themselves. Borrowing in yen to fund these investments wasn't a gamble. It was a natural financial match, the kind of thoughtful alignment that most investors ignore. Most people don't realize how dangerous short-term thinking is. If you start adjusting strategies based on how it will affect next quarter's numbers, you begin walking down a dangerous path. At first, it's minor. You tweak a projection, adjust a metric, but over time, the temptation grows to manipulate results instead of building real value. The scoreboard becomes more important than the game. This isn't hypothetical. Warren has seen it firsthand. People he trusted in other areas who began distorting financials just to hit targets. That's why Berkshire avoids this mentality entirely. They don't build businesses based on what the earnings call will sound like. They build for 5, 10, 20 years from now. And that mindset is what has kept them resilient through decades of change. In truth, most companies and countries are operating with unsustainable models. The United States, for example, is running a fiscal deficit that simply cannot continue forever. Whether it collapses in 2 years or 20, no one knows. But the end is certain. You can delay reality, but you cannot escape it. Inflation is a quiet thief in the system. It rarely arrives loudly. It builds in whispers. A subtle increase here, a new policy there, a few extra stimulus packages, and before long, your money no longer buys what it used to. This is not a flaw of one nation. It's the default behavior of governments over time. History proves it, over and over again. And yet, most people have no defense. They believe their currency is sacred, their system stable. But if you study the great inflations of the post-World War II era, the list is long. The names repeat. The consequences escalate. And the citizens always look back wondering how they missed the warning signs. That's why Buffett's concern isn't about a quarterly earnings miss. It's about the architecture of the financial system itself. Once a government realizes it can print money to meet obligations, the line between necessity and indulgence blurs. The temptation to use monetary tools as political tools becomes irresistible. It's not that these leaders are evil. It's that the system makes it easy to choose the path of least resistance. Want to win votes? Promise more spending. Want to avoid cuts? Print more currency. And over time, the currency erodes. Slowly, then all at once. This is why checks and balances are so difficult to maintain. You can write laws, set caps, establish frameworks. But in the end, the will of the people, or the politicians they elect, often pushes past restraints. And no economic theory can stop a nation from overpromising when the incentives are aligned to do just that. That's why Berkshire's cash position isn't just a safety measure. It's a response to systemic risk. It's an admission that not everything can be controlled, but preparation is still possible. When the next big financial wave comes, they'll be ready not because they predicted the moment, but because they respected its inevitability. And here's what most people miss. The biggest dangers aren't always visible. They don't appear in headlines. They appear in habits, in policies that sound helpful, in budgets that no longer balance, in debts that no longer shrink. The real crash doesn't start with a bang. It begins with silence. So, how do you protect yourself? You don't need to become an economist or study currency markets every day. But you do need to understand one thing. Your wealth isn't just about what you earn. It's about what your money can still buy 5 years from now. If your savings aren't outpacing inflation, you're going backward. Even if your bank balance looks healthy. This is why true investors watch the system, not just the scoreboard. They know that cash, when managed wisely, becomes a weapon against uncertainty. That discipline today creates freedom tomorrow. That the time to prepare is before the chaos, not during it. And perhaps most importantly, they understand this. In a world where currencies weaken, patience strengthens. When others rush, the wise wait. When the system bends, the prepared stand firm. And when opportunity returns, because it always does, they're ready. If you're still reading this, you're already ahead of most. But here's something even more important. Many people who benefit from these insights never subscribed. Take a moment to check if you're subscribed and if notifications are on. That way, when the next lesson drops, you won't miss a moment that could change everything. When the storm hits, most people run for cover. The headlines scream. The markets drop. Fear spreads. And in those moments, the vast majority of investors panic. But for a few, a very rare few, these moments don't bring fear. They bring clarity. Market volatility isn't a bug in the system. It is the system. Prices swing, sentiment shifts, and value temporarily disconnects from fundamentals. That's the nature of every market in history. And while the average investor sees chaos, the disciplined investor sees opportunity. Warren Buffett has seen Berkshire Hathaway's value drop by 50% 3 different times. Not because the company was broken, but because the market was having one of its moments. These weren't just corrections. They were gut-wrenching crashes. And yet, in every case, the long-term outcome was the same. Recovery, growth, and a new high. This is where temperament beats intelligence. You don't need to be the smartest person in the room to win in investing. You just need to be the most emotionally stable. If a 15% drop in your portfolio causes anxiety or doubt, the issue isn't the market. It's with your philosophy. Because markets don't adapt to your emotions. You have to adapt to them. Volatility will always return. It is cyclical, inevitable, and deeply rooted in the human nature behind market behavior. The world will make massive errors again, because it always has. Economies will overheat, bubbles will burst, governments will overextend. And when the dust settles, those who prepared, who stayed calm, who stayed liquid, they'll step in and shape the future. Buffett put it simply. If you get excited when markets rise and depressed when they fall, you're not suited for this game. And that's the core of it. The market isn't just numbers and charts. It's a mirror. It reflects how you handle uncertainty, risk, and time. It doesn't reward the impulsive. It rewards the steady, the patient, the prepared. Let's rewind the clock. When the Dow fell from 381 in 1929 to just 42 in the early 1930s, that wasn't just a correction. It was a financial earthquake. Families lost everything. Institutions collapsed. But those who held on, or even bought during the collapse, emerged on the other side with fortunes. Buffett himself was born into that chaos. He saw firsthand what happens when the system buckles. And that's why he doesn't fear volatility. He respects it. He prepares for it. And most of all, he uses it. Here's the truth no one wants to hear. Volatility is your friend. If you're ready, it shakes out the weak hands. It discounts valuable assets. It reveals who is swimming naked. And for those holding cash, clarity, and conviction, it opens a door to once-in-a-decade opportunities. So if you want to thrive, stop trying to predict the next move. Stop chasing the next headline. Start preparing for the inevitable shakeup, because it's not a question of if, but when. In fact, imagine this. 5 years from now, there's a crash that makes 2020 look small. Will you be scrambling to sell or calmly stepping in to buy? That's a defining difference. Preparation is not just about having money. It's about having the right mindset. It's about building conviction before the chaos, so that when everyone else is paralyzed, you're moving with purpose. And the way you build that conviction is by learning now, by thinking long-term, by knowing the history, by honoring the principles. Buffett doesn't pretend to know what the market will do next week or next year. Neither does Greg Abel or Ajit Jain. Why? Because they understand that the game isn't about predictions. It's about positioning. They know that speaking confidently about the unknowable is easy. But building your life around what's knowable, like the power of discipline, the resilience of value, and the returns of patience, that's where the real magic happens. They don't rely on forecasts. They rely on frameworks. And that's what you need to build. Even in geopolitics, Berkshire's vision remains the same: support global prosperity. Trade should not be used as a weapon, and the more balanced the world becomes, the safer and more prosperous we all become. That's why Buffett once proposed import certificates, not as protectionism, but as a tool to balance trade and strengthen long-term cooperation. And that matters, because a world full of envy, scarcity, and conflict is dangerous, especially when nuclear powers are involved. Economic strength should not be used to gloat. It should be used to build a foundation where everyone can rise together. In the end, wealth isn't just about capital. It's about wisdom. It's about building something resilient, not just profitable. Something you can pass down. Something that grows not in spite of crisis, but because of how you responded to it. Let the others chase noise. Let them panic at headlines. Your job is to build a kind of mindset that sees through the fog. Because the next time volatility strikes, and it will, you'll have a choice. Run like everyone else, or rise like few ever do. By the way, if this message resonated with you, take a second to drop a comment below. What part of this reflection felt most true to your own experience? And don't forget to like and share this with someone you know needs to hear it.